FedWatch Advisors founder Ben Emons.
Come on.
You ask and you shall receive. Ben,
So
welcome.
magic.
Thank you.
What do you think? What are you expecting? How do you think the markets will react?
So it will be a soft print, I think, because, the ADP number, I think, is, as much as people talk about that as not a good number to estimate, within that number, leisure, construction, that all has slowed down a lot. And then I looked at the ISM data today, too, and it's like, there's data in there from high unemployment versus low unemployment. That percentage is really contracting, which is kind of like a differential, like the Conference Board is a labor differential. So that indicates deflating momentum in the labor market. So it doesn't look to me like a strong number that could come out of this, despite all the statistical issues that we deal with these payroll numbers these days, because, who knows what revision will be. But yeah, to the discussion, a soft print, not necessarily good news for the market in that way, because it does set in motion again. We're slowing down. We're seeing more and more evidence coming through the labor market that we are really slowing down. Deflating labor momentum ultimately leads to more contraction. Right? And I think this is where we're sort of at the edge here, why markets are kind of trepidating. If we're getting a negative print, which I don't think will be the case, then it would be really risk-off. So the only way that we could get a positive upside surprise because of statistics. So it looks to me like a soft print, not a good market reaction.
So will the number tomorrow, in your view, given your scenario, let's say that is actually what happens, does it change the Fed in what it does?
It probably keeps them at 25 basis points. But to what you were discussing, like Goolsbee and Waller have been about, once the unemployment rate starts rising, it doesn't stop. Mm-hmm. And so to Guy's point, like, you are getting behind the curve, you got to do something, right? You got to do faster. That is that 22 scenario of, like, we got to suddenly do 50 or 75. I wouldn't be surprised that actually would happen if you get this big uptick in unemployment rate, that they react to that quicker. On the other hand, if you have a labor market that's just sort of where it is, and claims are, I think, a reasonable indicator, right? Then I guess you could do the staircase 25 starting and then see what happens. Ultimately, this is the economy still in a soft landing. So if you ease too fast, too quickly, the inflation problem comes back. So it's a bit of a asymmetry here. I think this Fed is very sensitive, though, to the unemployment data. So I think what Bostic said the other day, and Daly, too, they're kind of worried about if we're too behind the curve on this picture on the unemployment rate going up too quickly. I do expect the Fed to react more aggressively.
25 or 50 probably doesn't matter, as we've all said. And if you look at the jobless claims, I think we're at, the 4-week average is at 6-month lows. So there's nothing in the jobless claims number that are concurrent, at least in terms of reading the labor picture. Does this change any view, and what is your view on the second half of 25? Where is the economy? Because we all know this could happen pretty quickly, and I mean a slowdown.
No doubt. And I think that's the 2025 are really about what they're ultimately going to do with fiscal policy. Because you see the speech from Trump today where he makes a big case about, I'm going to put, Elon Musk in there to start looking at spending, right, and start evaluating that. Now, say he's right, then we're getting a big picture, right, a big change in the fiscal spending picture. So I think that's what the drivers for next year. This sort of phase we're in right now, where the Fed is really in control of the economy, lowering rates if it has to to control the unemployment rate. I think that really matters currently. We'll see what happens after the election, but I do think the Fed will react, though, to this negative data if it comes out. So next year is the fiscal picture. I think that's a totally different scenario.
Ben, we went a month ago for, a lot of folks are like, oh, maybe it's not going to be a soft landing. We're going to have a hard landing, which takes me back to kind of 2022, right? And we think about, a lot of folks were kind of positioning for a recession that was supposed to happen in 2023. We had an earnings recession, right? But, we didn't have that recession. So that's been pushed out. There's a whole host of reasons for that. When you think about next year, I mean, like, what are the probabilities in your mind? It sounds like you're prepared for softer data, specifically employment data. What is the chance in your mind that we actually do finally have that recession that a lot of folks were kind of planning on last year?
Yeah, Dan, if you think of the yield curve, right, the rates re-steepening to flat, and we have a flat curve, which means uncertainty, and I think that's what we're currently discussing. We don't know exactly the picture. That next year, a much more steeper curve does indicate that we're in a lot softer environment. Again, it does, I think, depend much on what happens in Washington with fiscal spending, how dramatic that will be cut, yes or no, against what else is being promised in terms of tax cuts as well, right? So that does matter, I think. But it does show that we are in a more and more decelerating phase of the economy. Hard to predict when that recession will hit, but it ultimately could happen if you particularly bring fiscal policy really to a halt. Yeah.
Ben, thanks. Good to see you. Ben Emons, FedWatch Advisors.